Recording here. I'm going to share this. Chapter 18 is all about taxation. And so far in the class, we've only talked about one form of taxation in real estate. We've talked about property taxation. And property taxation is still an important piece of the puzzle, but it's just not what we're focused on here in Chapter 18. We want to focus on all of the moving pieces that go into property taxation, that go into taxation other than property taxation, I rather should say. So there are lots of taxes that are influenced by real estate or are taxes related to real estate other than property taxes. And so we want to focus on those in this chapter. The first thing to do when you start talking about taxation is just remind you of the difference between property taxes are taxes that are paid by a property owner, a real property tax owner, a real property owner pays taxes every year to whatever county and or city that their property is located in. And those taxes are, just to kind of rattle your brain, does anybody happen to remember what law in North Carolina sets up the property taxation? What law says that you have to be taxed based on the value of your property? Does anybody remember that?
Machinery.
The Machinery Act.
Oh.
So I heard somebody say it. I don't know who it was, but somebody said the Machinery Act. And that is correct. The law that governs property taxation in North Carolina is called the Machinery Act. And remember, we tax a property based on its value. But there are other taxes that people have to be aware of when it comes to real estate transactions. And that could be things like their annual income taxes, because owning real estate can affect their annual income taxes. But then there are also taxes that have to be paid when property is sold, potentially, that we need to talk about. And so that's what we're going to focus on now, the yearly income taxes, as well as the taxes that might have to be paid when the property is sold, which are called capital gains taxes. So let's focus first on the annual income taxes part. That's what we're focusing on now. We're not talking about when you sell the property. We're not talking about when you buy the property. We're talking about while you own the property. How many of you have ever heard people say, oh, well, there are tax benefits to owning your own home? How many of you have ever heard people say that? Right? What they're talking about are income tax benefits, federal income tax benefits related to home ownership. And these are for homeowners. And most of them are tied to the loan that somebody gets to purchase a home. If you have a home and you have a loan on that home, you get to deduct on your federal income tax return the interest you pay on that mortgage loan every single year. And you actually get to deduct it on two homes. How many of you knew one of those? How many of you knew one of those could be a motorhome? Did you know that? Or even a boat, if it's got a sleeping quarter on it, potentially. So there's all kinds of interesting things you get to learn in a real estate class, that you get to deduct any interest you pay. So if you go out and buy yourself a motorhome, can you call that a second home and deduct any interest on the loan on that thing against your income taxes? Yeah, you can. We haven't talked about financing yet, but when we do, something called discount points. Basically, any loan-related fees that you pay when you take out the loan can be tax deductible. So discount points can be any mortgage insurance premiums you have to pay are tax deductible. Origination fees, which is another example of a loan-based fee. Those are all deductible on your income tax return. The big one, of course, is this one, the interest. Why do you think that's the big one? Because you get it every what?
Every year.
Every year, year after year after year. And these are not small deductions.
I have a question.
Go for it.
Discount points, since you only technically pay for them one time, you can only deduct it one time?
That's exactly right.
Okay.
That is exactly right. So things like discount points and origination fees, you'd only be able to deduct them one time the year you bought the property. But something like the interest, which is ongoing year after year after year, you'd be able to deduct over and over and over. Okay? All homeowners, whether they have a loan or not, can deduct their property tax bill as an annual deduction from their income tax return. So that's something else they may ask you on the test. What things are deductible on someone's annual federal income tax return as a result of owning a home? Well, any interest paid on the loan plus any property taxes paid on the property or tax deductible. Does this show you right away why there are some benefits to homeownership that you don't get as a renter?
Yeah.
Because if you're a renter, do you get these deductions on your income tax return? No, and that means you're going to
The landlord does.
You're going to pay more in federal income tax as a renter than you might otherwise as a homeowner. So that's one of the benefits of homeownership. Any questions about annual income taxes so far? We're not going deep into annual income taxes, by the way. That's something we can spend hours and hours and hours on, but we're not for you all. How many of you do your own taxes? Okay. Well, those of you that do your own taxes, this makes a lot more sense. If you don't do your own taxes, you may have to grapple with some of these ideas just a little bit.
So an annual income tax basically just these are all the things that can be deducted from that?
That is correct. So these things help to reduce or offset some of your annual income tax liability to the federal government. If you own a home, the property taxes that you pay on that home to your local county help reduce the income taxes you pay to the federal government. If you own a home, the interest you pay on your home loan helps reduce the income taxes that you pay to the federal government. That's what we mean when we say these things are tax deductible.
Okay, so it makes it a less amount that you have to pay.
Correct. Basically you're saying I don't have to pay as much in federal income tax because I already paid this in property taxes. I don't have to pay as much in federal income tax because I also paid interest on a mortgage loan, and those things help me with my federal income tax bill.
Thank you.
Okay. This tax is a sales tax. When do you pay a sales tax? When property is what?
Sold.
Sold.
Purchase.
Capital gains taxes are paid when property is sold, when it changes hands. Now, you only pay a capital gains tax. Capital gains tax is a little bit different than sales taxes, though, in the sense that sales taxes are based on purchase price. And so it's not really a sales tax. It's a profit tax. That means you only pay a capital gain tax if you have a capital gain. What do you think a capital gain is? Without giving me fancy terminology or anything like that, what do you think a capital gain is? When what two things happen, or what thing happens?
When you make money
off something.
You make money off of it. How do you make money off of a property? You sell it for what?
More than what you paid for it.
More than what you bought it for. That's exactly right. Is that possible with real estate? Do a lot of
Yes.
people
Oh,
sell
yes.
real estate for more than what they paid for it?
Yes.
Yes.
Mhm.
Especially in Raleigh.
Especially in Raleigh and China, no doubt about that. So in its simplest terms, I want to simplify this as much as I possibly can. In its simplest terms, a capital gain is just a profit on the sale of real estate. I sold it for more than I paid for it. Simple. Capital gain. Unfortunately, that comes at a little bit of a penalty. Is it nice to make money on something, first of all?
Hell yeah.
It
Oh,
is.
yeah.
Guess who is standing in line going, nice. We glad you made some money on that.
Uncle Sam.
Uncle Sam. The United States federal government will greet you at the closing table and say, we are so glad you made money on this property. Pay us, because that gain is taxable. Does that make sense for everybody?
Yep.
That is a capital gains tax, a capital gain. Now, is it possible also, I mean, we have to at least throw the possibility at it, is it possible to have a capital loss?
Yes.
Absolutely.
Yeah, you could end up selling property for less than you paid for it. Now, obviously, you don't have to pay a capital gains tax if you lose money on the transaction, only if you make money. Thankfully, they're not quite that evil. So Yusra said, oh my God, you pay tax when even you sell your house. Well, right now, Yusra, the answer is yes. What I'm going to tell you down the road is maybe not, depending on if you qualify for an exception. There are exceptions to this rule, and that's why it's important to know when the exceptions apply, because you got to know whether or not you're going to have to pay a tax when you sell your home, okay? But in general, if you make money off of it, you got to pay taxes. Now, the way capital gains taxes work is they can either be called a short-term capital gain or a long-term capital gain. The government is not very smart. They don't come up with like big complex formulas for how you tell the difference between a short-term capital gain. The simple truth is, if you own the property from the day you bought it to the day you sold it for less than a year, what do they call it?
Short-term capital gain.
That's short-term. And if you own it for more than a year, they call it a what?
Long-term.
Long-term. So I want y'all to think about like reality television. If you watch something like, Flip or Flop, or one of these television shows that flips property, are they mostly dealing with short-term capital gains or long-term capital gains? Which one are they?
Short-term.
Short-term.
Short-term. Because very rarely do they own the property for at least a what?
A year.
A year. They'd probably be pretty upset if they own the property for a year, correct?
Yes.
And they want to turn it and burn it. Does that make sense for everybody?
Yes.
I will tell you though, there is one potential benefit to owning it for at least a year. Look what it says right here. It says long-term capital gains are taxed at a rate of what?
15%.
15%. Now it can go up to 20%, but gosh, that's for people who make $250,000 or more. And so it's very rare. Most people, the vast majority of people, pay 15% on long-term capital gains. Let me ask you something. Those of you that do your own taxes, are most people in a significantly higher tax bracket than a 15% tax bracket?
No.
You don't think so?
Yes.
The most common is 25%.
Mm.
That doesn't mean they pay 25% of their income, by the way. That's not the way tax brackets work. but your top tax bracket, what they call your nominal, the one that your
Oh,
total
okay.
income is in, the
Yeah.
most common is 25%.
Mhm.
That's the most common. Which is better, 15% or 25%?
15.
Mhm.
Which one? Which
15.
would you rather pay, 15 or 25?
15.
15.
15. If you're in a 25% tax bracket and you own that property less than a year, guess what your capital gains tax rate is?
25%.
25%. If you're in a 35% tax bracket and you own that property less than a year, guess what your capital gains tax bracket is?
Interesting.
35%. It's the same thing. So if you have somebody who's in a 35% tax bracket, might they be interested in holding that property for at least a year?
Yes.
Because it drops the taxes on that sale from 35% of the profit down to what?
15.
15%.
15.
Just by owning the property for at least a year. Does everybody see the difference, the dramatic potential difference there for owning property longer than a year? Are we all okay on that?
Yes.
Yes.
So basically, short-term capital gains are going to be taxed at whatever your normal income tax bracket is. But long-term capital gains are going to be taxed the same for everybody, which is at 15%.
Okay.
And so that's why a lot of investors do like to hold property for at least a year so they can control that taxation.
So it's more for less than a year, typically?
Yes, because the tax brackets are almost everyone is in higher than a 15% tax bracket. So,
Okay.
you know, if somebody's in a 25% tax bracket and they sell a short-term owned property, they're going to pay 25% taxes on that sale.
Okay.
Whereas if they held that same property for at least a year, they would only pay 15%.
Okay, that makes sense. Thank you.
Yeah. So that's the motivation to hold the property for at least a year. Are we all okay on that?
And those taxes are only for the profit.
For the profit, right. Well, that's what we're talking about. 15% of the profit generated on the sale, not of the sales price, but of the profit itself. Okay.
Mr. Trev,
Yes.
I got a quick question for a little personal information. This coming from a real estate agent that he informed me that if you have a property for 2 years or better, you don't have to pay any taxes on that. How true is that?
Hold that thought. We're getting there. Hold that
The
thought.
roof is on fire.
We're getting there. Because listen, if you don't learn anything else at all from me, learn this. You need to know all the ins and outs of the tax code if you're going to be involved in real estate. Because the same transaction could cost somebody $50,000 in taxes or zero in taxes based on small little differences. Could you instantly look like a hero to your real estate clients if you save them $40,000 or $50,000 in taxes?
Oh, yeah.
Absolutely. Yeah.
Absolutely.
Smart.
So you do need to understand the basics of how this stuff works. All right. Are we all good on the difference between a long-term and a short-term capital gain? Yeah. Okay, good. So here's the terminology when it comes to calculating the profit. What is the capital gain or the profit on the sale? Here's the way to think about it. This is how much I paid. This is how much, I'm sorry, not paid, how much I sold it for. My brain's dead today, apparently. And this is how much I paid. And this is my profit. If I take the amount I sold it for and subtract the amount I paid, am I not going to be left over with my profit? Does that make sense for everybody? I mean,
Right.
we already know how to do that in real life. If I said, oh, you know, he bought that car for $1,000 and fixed it up and sold it for $3,000, you would instantly say, oh, he made how much profit on the sale?
2,000.
2,000. If I said to you that Daniel bought a car for $1,000 and he fixed it up and sold it for 3,000, you would instantly tell me he made how much profit?
2,000.
2,000.
$2,000. But here's the thing, that ain't the whole story. Did he probably have to spend more money than that to fix it up? Did he probably have to buy parts?
Yes.
Yep.
Yeah, and maybe pay for some labor and all that stuff. So what if he had to spend $1,000 fixing it up? Did he really make a $2,000 profit, or did he make $1,000 profit?
$1,000.
2,000.
He made $1,000 profit because he also had to spend. So here, this is my point. How much I paid for it, this number right here is called an adjusted basis. And the reason we call it an adjusted basis is because it's not just what we paid for it. If you look at that, if you look at the information on that slide, it says it's the purchase price plus basically any other money we had to spend on the property. We had to have, if we had a survey, we're going to add that in. If we had inspections, we're going to add that in. If we had to pay a closing attorney, we add that in. How about if we added on something to the property? If we, you know, if we put in new hardwood floors and we put in a new kitchen, do you think we would add that into our adjusted basis? Would that count in what we invested in the property?
Of course.
It sure would. So this is not really how much I paid, but another way to say this is how much I invested. Because I could have invested money over time while I own this property. That's called my adjusted basis. You need to know that terminology. Adjusted basis. That's the total investment that a seller has in a property. Everybody with me on that?
Yep.
Okay. And then when I look at the other piece, the how much I sold it for, we call that the amount realized. The amount realized is not just how much I sold it for. It's how much I sold it for minus the money I had to pay to get it sold. So, like if I had to pay commissions, do you think I should probably take that out of how much I sold it for before I start calculating my profit? Right? So this is like what you sold it for minus things like commissions and excise taxes and attorney's fees and all those kinds of things. And so what I would say, rather than how much I sold it for, how much I got from the sale. So how much I got from the sale minus how much I invested will give me my profit. How much I got from the sale minus how much I invested will give me my profit. And that is called a capital gain. That make sense for everybody? That's called a capital gain. And you pay taxes on that. And how much you pay in taxes is going to be dependent upon how long you've owned the property. If you've owned it for at least a year, what rate are you going to pay taxes?
15.
15%. If you own the property at least a year from the day you purchased it till the day you sold it, then your taxation is going to be capped at 15%. So this is just kind of an example of how a capital gains tax gets calculated. Says Travis purchased an investment property in 2005 for $150,000, and he's selling it for $228,000. Well, if we were just doing raw profit, we would just say $228,000 minus $150,000. And that would be, you know, what is that? $78,000 profit, something like that. The problem is we didn't take into account if he might have invested other money or did anything like that. And that's where the rest of it comes in. It says he incurred closing costs, attorney's fees, appraisal, inspection of $1,500 when he purchased the property. And he's done renovations to the property totaling $32,000. Do you think that should count when we start looking at
Yes.
capital gain?
Yes.
Yeah. At closing, he's paying a 6% commission. You think we should take that into account?
Mm-hmm.
Yeah, sure, all of that. And so what was his capital gain on the property? Well, so if you look at this, when you break it all the way down, his capital gain is going to be much less than $78,000 because we're going to want to reduce that by, you know, the $1,500 he had to spend when he purchased the property and the $32,000 in renovations that he did and the attorney's fees of $400 and the excise taxes of $456 and the 6% real, you know, commissions. All of those things will dramatically reduce that capital gain. Does that make sense for everybody?
Yeah, can you do this one?
Can I do it? Sure.
That'd be my-
Yeah, I can do it. So let's just take a look real quickly. Let's do his adjusted basis on this side. And then we'll do his amount realized on the other side. And see what we come up with. Okay, so we got amount realized. So the adjusted basis is how much he's invested in the property. What's the first number he invested in the property?
150.
150,000.
Yep, $150,000. So that's where we start over here. And then it says he incurred closing costs of $1,500 when he purchased the property. Well, that's money he invested. So plus $1,500 over here. Okay, so we've taken care of that. He's done $32,000 in renovation. So that's money he's invested. So we would add that over here. And then it starts talking about at closing, he's paying a 6% real estate commission. Well, at closing, he sold it for $228,000. Somebody got a calculator handy? Want to tell me what 6% is of $228,000?
$13,680.
Okay, so he paid $13,680 in commissions when he sold it. So we dealt with that. He paid excise taxes of $456. And he paid attorney's fees of $400. So when we take all of that into account, 228 minus 13,680 minus those two numbers, looks like 213,464 for an amount realized.
Mm-hmm.
And then for his adjusted basis over here, that looks like 183.5. And to come up with the capital gain, what you would do is simply look at the difference between those two numbers. So you would say 213,464 minus 183,500. What's his capital gain on the property?
29,964.
29,964.
Yes. So everybody else got that?
Yes.
Yep.
29,964. Now you're not expected to do that math problem on the exam any longer, but you do need to know how it works because you need to know it's adjusted basis and amount realized. It's the difference between those two. Because is that a big deal? Remember, when we were just looking at the raw numbers, it looked like he was going to have to pay taxes based on $78,000. But now he only has to pay taxes based on what?
29,900.
29.
So he would pay 15% of that as taxes. So if you took 15% of that number, that would be his taxes, which is $400 and some change, I think, off the top of my head.
$4,494.60.
Yeah.
Wow.
That's what he would pay in taxes. Everybody all right with that?
And that's a big difference.
Huge, huge, okay? That's how you calculate a capital gain. Now, here was Daniel's question, and Yusra, this is what I told you should look out for, because Yusra was shocked that she might have to pay taxes even when she sells her home. And then Daniel said some crazy ass real estate agent told him that if you owned a property for at least 2 years, you didn't have to pay any taxes when you sold it. And so let me tell you exactly what this exemption says. This exemption says if you are selling your primary residence, then you are exempt on paying capital gains tax unless you have a gain of more than $250,000 as a single person, or a gain of more than $500,000 as a married couple. Now, not sales price of $250 or $500, but gain. Look, I mean, look at this last transaction we just did. I mean, we sold the property for $228, but the capital gain was only what? $29,000. So are these pretty big numbers for capital gains?
Heck
Yeah,
yeah.
pretty much you have to cut someone's head off in order to be exempt.
I mean, it's very unusual for somebody to sell their house and have bigger than these numbers as far as gains. You're probably not going to have very many clients in your real estate career who have a capital gain of more than $250,000 on their home. Is everybody with me on that?
Yes.
Now, the only rule that you have to meet in order to legally claim that is your primary residence is you have to live there. You have to reside in the home for, in fact, it's the same as the BIC rule. You have to live there for how long?
2 years.
2 years.
For 2 years.
2 years.
And that 2 years has to have taken place within the last what?
5 years.
Within the last 5 years. So if you've lived in that home, so could it be currently an investment property for you? Even rented out right now, could you still sell it and say, this is my primary residence? Yeah, as long as you live there, what?
For
Oh,
2
yes.
years out of the last 5
At
years.
least 2 out of the last 5. If you lived in that property for at least 2 out of the last 5 years, you don't have to own it. Could you own it for just 2 years and qualify for this?
Yes.
Yes.
Yeah, as long as you live there the whole 2 years. That's right. So if you've owned it for at least 2 years, if you've lived in it as your primary residence for 2 out of the last 5 years, at least, then you qualify for this exemption. And this right here is why the vast majority of people will never pay a capital gains tax when they sell their what?
Your primary residence.
Their home, their primary residence. This is a wonderful thing about the tax code right here. This prevents a lot of people from paying a lot in taxes. And you can thank the National Association of Realtors for this exemption. This is one that the National Association of Realtors has fought for long and hard over the years. And there have been many times when discussions come up about changing the tax code, rewriting the tax code. This is one of the first ones that comes up for discussion, and the National Association of Realtors goes to war for this one every single time.
So you're saying is
Would people sell their home a lot less commonly if they had to pay a 15% tax on any profit every time they sold it?
Yeah.
Absolutely.
Absolutely. Absolutely. One of the main reasons people don't think twice about selling their home is they don't have to pay any taxes. Is that okay? Is that making sense for everybody?
Yes.
Yep.
And so all we do is just double the amount if somebody's married. It's $250,000 in gain is tax-free. Now, you don't completely lose the exemption. If you happen to be a single person and you had a $300,000 gain on your property, first of all, it's nice to be you. But secondly, you wouldn't pay tax on the whole 300. You would still get the first 250 tax free. You would just pay tax on the amount above that.
Okay.
Okay. So you're saying that, okay, stay in the property 2 years as your permanent as your permanent resident, and then the third year you could turn around and rent it out. And
I
then-
lost you on the last part, Charlene. You went out.
So you stay in the property for 2 years as your permanent resident, and then turn around and rent it out. You're still eligible for the exemption.
Yes, as long as you have lived there 2 out of the last 5 years, you're eligible for the exemption, even if it's currently rented out. So if you bought the property, lived in it 2 years, rented it out 2 years, and then sold it, you could still sell it as your primary residence because you have lived there for at least 2 out of the previous 5. But now, if the last time you lived there was 6 years ago, you can't sell it and take this exemption.
So it has to be within the 5 years.
I'm sorry?
So it has to be within 5 years.
That's correct. The living experience has to be within the last 5 years. So right now, if you're selling property, you're looking back to 2015. Have I lived in the property for at least 2 years since 2015? Okay.
But if you okay, I just want to make sure I got this right. So you 5 years, you go back to 2015, you lived in the property for 2 years, you rented out for 4 years, which makes 6 years. At that point, you're no longer exempt. You have to move back into the
Right, correct, because only 1 year of your living there would be in the last 5, right? If you lived there for 2 and then you moved out and rented it for 4, well, if you look in the last 5 years, you only lived there 1 year out of the last 5 at that point. So you'd have to move back in for another year to make it work.
Okay.
Or just sell it and eat paying the taxes. You can always do that, but a lot of people don't want to do that. They don't want to pay the 15% taxes. Okay?
So I just had a question about the first 250. Does that mean that if you make $250,000 like as capital gain, you will get taxed?
No, that means if you make more than 250 as a capital gain, you would be taxed on the amount above 250.
As a single person.
As a single person. If you had a capital gain of more than 500 as a married couple, you would be taxed on the amount above 500. So the first up to $250,000 in gain is tax free, but after that you pay capital gain.
Oh.
So like Travis's 300,000 would be a $50,000 tax, right?
Well, $50,000 of the gain would be taxable. You wouldn't pay $50,000 in taxes. You would pay 15% of $50,000.
Okay.
So basically, the first 250 are tax free, and the first 500 are tax free. Anything above that isn't protected.
Right. That's exactly right. And that's very rare in a residential transaction. Very few people, make this kind of a gain on their home unless they've owned it for a very long time, or they're in a market where prices have just rocketed up, and they haven't really spent money on the property while they've owned it, because, all that gets factored in. So it's very unusual for people to have gains in excess of this amount.
Travis, I know this is not North Carolina, but I had an aunt that lives in Washington, D.C., and she was inner city.
Yep.
And the area was changing. So they came in and offer almost double, triple value of her home.
Mm-hmm.
So she fell into this category.
Okay. So yeah, it could happen for sure. Yeah, it could have, like I said, and depends also your market. Like if you're in San Francisco, for example, or San Diego, where the average house, is $2 million. Well, it's not hard to imagine if you pay $2 million for it and you sell it 5 years later, you might sell it for $2.5 million. It's not hard for them to imagine, how they might have a $500,000 capital gain, but it's pretty rare around here on a home. Okay.
Travis, question.
Yes.
So let's say based on this
on this statement here. I was just thinking of a friend right now because he has a property downtown. And right now he's renting it. He is married, so he's not selling the property yet. But in the long run, he is planning to sell it. So it would be good advice like, hey, you can rent it now if you're planning to sell it at a certain amount where, you know, like you can have less taxes, then stay there for at least 2 years within the 5 years. Now, can he file as a married couple jointly, even if it's just himself staying in that property by himself, or do they need to live there physically, both of them?
No, I think as long as one of them lives there as a primary residence, they can probably be fine with
Oh, really? Oh my gosh. That's a lot of taxes, I mean, a lot of money saved in the future.
Yes.
Damn.
Yes. I mean, and I have given advice in the past of people who've been renting out property for years and years and years and said to them, you know, you could save yourself quite a bit of taxes here by simply moving back into the property for 2 years.
Yes. Well, he already lived there like, you know, a few years before. So now he's just renting it. And then he told me, Lucci, I'm going to sell this property in the future, but not now because Raleigh is planning to build another 40 stories condominium. So now's not the time. I'm like, yeah, just rent it. So now this, oh my gosh, that's a lot of money.
Oh, yeah, absolutely. So watch how long he's lived out of the property. And when he starts to get to the point where he's about to lose this exemption, it might be time to sell it.
Yes.
Okay. Good. I'm not going to go through the math of this one, but it worked. The math works exactly the same way. It's just they're exempt from paying the tax because it says that they're selling the home that she and her husband have owned for the last 38 years. So unless their gain is more than she and her husband, how much gain would they have to owe any capital gains tax on this property?
$500,000.
They have to have more than a $500,000 gain. That's exactly right. Okay. There is also a way to avoid paying a capital gains tax, even when it's not your primary residence, even when you're selling strictly investment property. There is a way to avoid paying capital gains taxes. Does that sound like a good idea, you all? If you'd like another way to avoid paying this tax, does it start to sound like you almost got to be stupid to pay capital gains taxes because there are so many ways not to pay it?
Several loopholes.
Yeah.
So there is another way to avoid the payment of capital gains taxes. Now, for some people, this is not feasible because some people need their money. If someone does not need to touch their money, they can avoid paying capital gains taxes by reinvesting the money in another property immediately. Basically, as soon as they sell one property, they can use that money to purchase what?
Another property.
Another property, and they will avoid having to pay a capital gains tax. Now, I think people sometimes wonder, well, then what's the advantage to that? Well, there is an advantage to that. Because when you sell, you probably are selling for significantly more than what you paid for. So when you go out and buy, you can buy a more expensive property than the one you just previously had, but using the same investment you used many years ago. Does that make sense? Like let's say you invested $50,000 many years ago, and now you want to sell that property. And you're going to sell it for $200,000, but you got this big capital gain. Could you not take the whole $200,000 and buy an even bigger, better property right now?
Yes.
And if you do that, you won't have to pay any capital gains taxes.
That is pretty.
What if you, like, for our house that we have the lease purchase thing that in Mississippi, but we've already bought this house, but we sell that one. Can we just invest it in this one?
No, because it has to be, there's a very limited time frame between when you sell the property and when you purchase the new property, and you will have elapsed that time frame. Okay. Now, obviously, this is not going to work for everybody because are there some people that when they sell property, they want their money? They don't want to reinvest it in a new property. And if they don't want to reinvest it, they're going to have to pay the capital gains taxes. But if they are willing to reinvest it, then they will avoid paying the capital gains taxes. And could they conceivably do this time after time? Could they sell the property again 5 years from now and reinvest that money in another property and not have to pay capital gains taxes?
Yes.
Okay.
Sure.
So let me show you how, because I think some of you may be oblivious a little bit, and not in an insulting way, but just in a you just don't know way, way about how wealth is built through real estate. Let me show you how this might matter quite a bit. So let's say, and we'll just take Kate as an example. She looks like a slumlord. So we'll just, no, I'm kidding. But let's say Kate purchases a property today in 2020, and she only has $25,000 to invest. And she borrows the rest, okay? She borrows the rest, and she purchases this property, but she only invests $25,000. Does that make sense for everybody? So far, so good. All right. Her investment out of her pocket is $25,000. And we'll just say she buys a property that costs $250,000. So she purchases property that's $250,000. Now it's an investment property, so she rents it out. And she rents it out every year. She gets $2,000 a month for this thing. Is everybody all right with that? She's renting this thing out for $2,000 a month, which is the same thing as, or $24,000 per year. Everybody good with that?
Tax.
We okay with that?
Yes.
All right. Now, let's just say that after she pays all of her expenses, she pays the mortgage payment, she pays everything, she makes a little profit of like $10,000 a year off of owning this property. Every year, annually. Does she have to pay income taxes on annual income?
Yes.
No matter where it comes from, right?
Yes.
She does. Let me watch what Kate's going to do. She's smart. When Kate files her income tax return, here's what her tax return says on there. It says income. $10,000. And then on the line below it where it says deductions, she writes in $10,000 in depreciation. Because the IRS will let her take that much depreciation on the property. In other words, she's telling the IRS that her property just dropped in value by $10,000. And now, whether it did or not doesn't really matter. That's what she put on her tax return. What's 10,000 minus 10,000?
Oh.
Zero.
So here's Kate's tax return for the year 2020. How much is she going to pay in tax, in income taxes for 2020?
Zero.
Nothing.
Nothing.
Wait, Travis.
It's smart.
Nothing.
You're saying that we can plug in any number for...
Not any number. There are limits, but I'm saying that's a number that would work in this case. She pays zero in income taxes. Is she going to do the same thing next year when she makes another $10,000?
Yes.
Yeah, she is. Is she going to do the same thing next year when she makes another $10,000?
Mm-hmm.
Is it legal to do that?
Oh, is it legal? How do you
It's illegal.
How do you think there are people that you see on TV that there are millionaires and billionaires and they pay zero in income taxes? The tax code was written for this. You
Jeff Bezos.
You poor suckers that actually work jobs.
My jaw just dropped.
You said it's legal?
I said this is how the tax code is written. Right? So
it's all about loopholes.
This is repeated year after year after year. Now, but she does have a problem. Kate has a problem.
Why'd you have to do me like that, Travis? Come on now.
I'll be surprised if there is no problem.
Every time she takes $10,000 in depreciation, that number drops because she's told the government that property is no longer worth $250,000. Now it's worth $240,000. Now it's worth $230,000. Now it's worth $220,000. Does that make sense for everybody?
So she better pay tax better than that.
She's depreciating it, which means when she gets ready to sell it, she's going to have an even bigger capital gain. So let's say she does this for 5 years. So now what does the government think her property is worth? $200,000. But she sells it for $500,000.
Oh, that's
breaking it in.
Does she have a capital gain?
Oh, dang.
Yeah.
Of how much?
300,000.
350,000.
No, $300,000 is her capital gain because they think it's worth 200 and she sells it for 500. There's her. Everybody with me on that?
Mm-hmm. But is it over 215, right?
Don't worry about that. It's not her home. It's an investment property. This is a rental property, so that exemption doesn't apply anyway. Does she have a big capital gain that's taxable?
Damn.
Does she?
Yes.
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 Except she's not going to touch that money. What's she going to turn around right away and do with that $500,000?
Buy another house.
Not a house, an
investment property.
Stop saying house. She's going to buy some type of investment property. That could be a house, that could be a warehouse, that could be vacant land. She's going to buy investment property, but it's going to be bigger and more badass than the last one she bought. Is everybody with me? Is she going to buy a bigger property?
Yeah.
Heck yeah.
And now if she's got $500,000 to invest, she's not going to just spend $500,000. She's probably going to spend $2 million because she's going to borrow money again, right? So now she's got her a $2 million property.
But Travis, how can you say that your property is depreciating, especially around here in Raleigh?
What do you mean? How do you say it? You write it on a piece of paper. That's how you say it.
Oh my gosh, we can just say that?
I'm telling you, that's the way the tax code is written. Because the idea is, this is how stupid the government is. They're going to get it. They think they're going to get it back when she sells the property, but she knows they're not. Because what's she going to do with that money because of this 1031 tax deferred exchange? She's
invest
in something bigger and better. And by the way, is she going to get a lot more rent on this $2 million property?
Mm-hmm.
Hell yeah.
Heck yeah.
Now she's got $200,000 a year in rent coming in. $200,000. Now she's got some expenses to pay, sure, but let's say after everything's paid, she's making $100,000 a year in profit. Now, you got to pay income taxes on that, right?
Yeah.
Surely. You know what? Kate has real bad luck with property, folks. Damn, if she didn't buy enough, it just loses value every year. I mean, it's almost like magic that she bought another property and she's making $100,000 a year off of it, but damn, it lost $100,000 in depreciation. Crap.
That's so sad.
No taxes to pay again this year. and next year and the year after and the year after. And she's going to do that until she sells this one. And then what's the next one going to look like that she buys?
$5 million.
1 billion.
10 million. She's going to roll it all into an even bigger one. And then she's going to be making $300,000 a year. And what's she going to do with that $300,000? Oh my God, this one's depreciating too. I can't believe it. Oh my God.
Travis.
Poor Lucci's mind is blown.
She's been waiting her whole life to pay income taxes, and she still doesn't get to do it because she's got zero income every year. Meanwhile, she's flying around the world on a private jet, but she's got no income.
That's her bad luck, flying around.
She's just unlucky.
Faith of genius.
Now, here's the crazy thing. Now, you want to hear the truly crazy thing about this whole scheme?
Yep.
And this, as if this part ain't crazy enough. Here's the crazy part. In theory, at some point, is there going to be, you know, the proverbial pay the piper? At some point, when that big, ginormous property gets sold down the road, is somebody going to have to pay a hell of a capital gains tax somewhere down the road? Does that make sense to everybody?
Yes.
It's never going to happen, because here's what's going to happen. Kate is going to leave this property to her children when she dies. And the current rules of the U.S. tax code say that if you leave that property to your heirs, they inherit it with a completely reset capital gain. They owe nothing in capital gains taxes, even if they were to sell that property at full price on day one. And so not only were no capital gains taxes ever paid on this property, that person who owned that property all those years paid no income taxes on the income generated by that property.
And I am not rolling in my grave over that.
That
quiet.
U.S. tax code.
As well.
Oh gosh.
So when people
is now
when people say to me taxation's boring, I say only if you don't like money.
Yeah.
Does that change the way you think about owning investment property right there?
Yeah.
Now, obviously, I gave you a very dramatically simplified example. There are rules that go into place about how much depreciation you can take and all those kinds of things. But just as a simplified example, does it really open your eyes as to how property could be depreciated to offset income and you don't pay income taxes, and then when you sell it, you avoid paying the capital gains taxes because you simply roll it into a new investment? Does that make sense for everybody?
Yes. Oh my gosh. I'm so excited. I'm sorry.
I feel dizzy.
That blew me.
But
So,
Travis.
Yeah, go ahead, Sharon.
Oh, I just kind of lost my. Oh, but what about when they come out and do the appraise every 8 years? How?
That's only for property taxation purposes. That has nothing to do with the actual income tax returns or capital gains.
Oh, okay, gotcha.
That's just for property taxation purposes. Okay.
Okay.
And so that process of taking the sale of one property and rolling it into the next one is called a 1031 tax deferred exchange. And it simply means taking what you sell one property for and rolling it immediately into the purchase of another. And now they can't take out just part of what the profit is. They got to take, I mean, it's every dollar. If you're going to be protected from paying capital gains taxes, you got to take every dollar from that property you just sold and reinvest it in a new property. And so basically always means you got to upgrade. Every time it's got to be a more expensive purchase.
And there's no limit to, oh yeah, I guess so.
Like how many times or anything? No.
No, I mean, how long once you sell it, you have to invest it?
There is a time period. You're not tested on that. You have a certain number of days from the time you close on one property to the time you have to close on the other. And you have to leave the money sitting in a trust account during that time. but it's a very
Right.
limited time.
Okay.
Very limited. It's 90 days. You only have-
What's 2 years? Is that the same thing Daniel was talking about?
Yeah, 2 years refers to if you're trying to take the exemption as a primary residence.
Gotcha.
That means you have to live in the property for at least 2 years if you're trying to take the exemption as a primary residence. But that is not what we're talking about, because these are investment properties.
Right. Okay.
Investment properties.
Mr. Travis.
Yes.
But real quick, but both exemptions cannot be used. Like if I use the one that you had earlier about reinvesting the money immediately, and upgrade to a newer property, and I decide to stay in that property as my primary residential for 2 years, and I decide to sell that property, will that other exempt come in play in that scenario, or I got?
Yeah, it could potentially. You could move into the property. I mean, assuming it was residential in the first place. I mean, if it's a warehouse that we're talking, remember, don't limit your mindset about real estate to residential property. Most of the properties that we're talking about with these 1031 exchanges are not residential properties. These are, these are warehouses and office buildings and shopping centers and, vacant land and hotels and storage units and all kinds of things other than residential property.
Thank you, sir.
Okay. That's it for taxation. I always love seeing people's reactions when they see that part of it. And, and it is overly simplified. Admittedly, it is overly simplified. Talk to your CPA, but the basic ideas are there.
Travis, are we going to talk about like the limits of depreciation, the money and what?
No, we do not talk about those. Basically, the IRS has a timetable for how quickly you can depreciate property, how many years you can depreciate it over. And it's about 3% a year, roughly, but 3% is a pretty big number.
Yes.
Yeah.
Okay. Well, thank you so much. That was mind blowing today.
There you go. All right, that is a good stopping point. Yes, Kate likes that we ended the class, but we also ended the class with "You did, Kate." So I'm not sure that was necessarily